Today we are going to discuss the topic Income Tax Act. The Income Tax Act is 1961. This act is related to the rules and regulation upon which the Income Tax Department levies, administrates, collects and recovers taxes. This act contains 298 sections, 23 chapters and several important provisions. The nature of Income Tax Act is it is a direct tax. The taxpayer must pay direct tax at a certain percentage based on his income. Features of the Income Tax Act 1961. The main feature is the income tax is a form of direct tax. So, the tax is paid by the person itself. It cannot be transferred to another individual. Second point is the central government is controls the form of taxation. It is applicable to the taxpayer's income which was earned in the previous year. It is applicable to the taxpayer's previous income only. The tax calculation is applicable based on the assessor's income tax slab. The tax rate is fixed on the income tax slab. The government levies a progressive income tax rate. So rich person and economically powerful individual have to pay taxes high rate. It is a progressive tax. So rich people pay high rate of taxes. Deductions applicable to the maximum limit for financial year in certain cases. Deduction is also available for this. Next topic is financial year and assessment year. The financial year is the year in which you earn an income. Financial year means the year in which we earn the income. Next one is assessment year. Assessment year is the year the following the financial year in which you have to evaluate the previous year's income and to pay tax on it. So assessment year is the year following the financial year, and on this year we have to pay tax on it. For example, 1 April 2023 to 31st March 2024 is known as financial year, and assessment year is start from the 1st April 2024 to 31st March 2025. Next one is previous year. The year in which income earned is known as previous year. So, the financial year and assessment year is different. In financial year is the year in which you earned the income. That year is known as previous year. In other words, previous year is the financial year immediately preceding the assessment year. Next one is different types of resident. As per the Income Tax Act, assessee is classified as resident, not ordinary resident and non-resident. If person is said to be or an assessee is said to be resident if he satisfies one of the following two basic conditions. There are two basic conditions. At least a person who satisfies one basic condition is known as resident. The first condition is stay in India for a year is 182 days or more in previous year. So the person must be stay in India at least 182 days in the previous year. The second basic condition is stay in India for an immediately for preceding year is 365 days or more than 60 days in the relevant financial year. So second basic condition is at least he has to stay in India 60 days in the previous year or 365 days preceding for financial year. The residential status is classified as resident, not ordinary resident and non-resident. If he stays 182 days in India, then he is known as resident in the previous year. If he stay less than 182 days in the previous year, then he has to calculate resident or not ordinary resident. So he has to stay 182 days, 365 days preceding 4 years or 60 days in the relevant previous year. Then he is known as resident but not ordinary resident. If the person not satisfy any of the basic condition is known as non-resident. Resident and not ordinary resident. If an individual qualify as a resident, if a person is qualified as a resident, next step we have to find it, he is a ordinary resident or not ordinary resident. He will be resident ordinary resident if we meet the following two conditions. These additional two conditions, if he is satisfied, he is known as resident not ordinary resident. He has been a resident of in India at least 2 out of 10 years immediately preceding previous year. He stayed in India at least 730 days in immediately preceding year. So if he not satisfy these two additional conditions, then he is known as resident but not ordinary resident. If a person not satisfy the basic condition, any of the basic condition, that person is known as non-resident. For example, 182 days or more in the previous year, or 60 days more than in the previous year, and 365 days in the 4 years preceding the previous